Thank you very much for joining us today. I am Alex Scanlon, the founder and CEO of Barton Gold. And per the very generous introduction, what we have done is established a dominant position in an historical gold field. About 10 years ago, we formed the view that gold was going to return to the center of the monetary universe. And I think we're all watching in real time how that's happening pretty openly. So we went looking around Australia for really interesting geology that was underexplored, preferably with access to infrastructure, and we settled on South Australia. We are a pure play precious metals developer. Started with gold, silver has grown into that portfolio, and we're focused in the central part of South Australia. So this is the Gawler Craton of South Australia, very well known as the home of Olympic Dam. We have an IOCG belt there, or a copper belt, that has been consolidated by BHP Billiton with their acquisition of Oz Minerals. Across the highway to the west, that same mineralized basin goes from being sort of deep in copper and uranium rich to shallow and golden rich as it comes near surface. And that's a 130-year-old high-grade gold producing district that was essentially dormant. So we spent a few years putting together deals to acquire pretty much the whole thing. We acquired every single major historical exploration and production asset in the region. We also acquired the only gold mill in the region. That's our Central Gawler Mill that sits at the Challenger project. And the idea here was not to take this back into operations too quickly, but rather to step back and build up something much bigger. So we've now spent the last 5 years essentially scaling this into a 2.25 million ounce gold platform that's capable of supporting 150,000 ounces per annum, utilizing a dual hub and spoke model. First, leveraging the existing mill that we have to operations, and second, building a high efficiency, large scale mill at our Tunkillia project. So we've done studies during 2025 that demonstrate that these two things are economically quite viable. We've brought these resources up. And now that we moved into the year 2026, we're essentially moving from the first 5-year act of our business, which is essentially proof of concept, into the commercialization phase. We have a definitive feasibility study underway at our Challenger asset and drilling, looking at upgrading those resources and essentially creating the plan for turning that mill on in any number of different scenarios. We have another 25,000 meters of upgrade drilling underway at our Tunkillia project. That will take that all up to measured and indicated inside of our optimized open pits, and we'll publish a pre-feasibility study for that by the end of the year. The idea is by the end of 2026, we want to have a very clear plan and pathway for both of these assets to go into operations so that we can make that transition, become a producer, re-rate the company's equity and credit profile, start generating cash, and then grow. The idea here is that we have laid out the growth pathway before we start operating. If you start operating first, everybody has the question, where's the growth? Well, we've laid that growth pathway out in front. In parallel with all of this, while looking for another feeder gold system, we found a really, really high-grade silver asset. So this has become essentially an interesting third focus for us for the year. That's our Tolmer silver discovery. We discovered that in the highest grade silver intersection in the world last year. So a lot going on. I'll take you through in greater detail. From a very high level, we're a pretty simple story. We have about 240 million shares on issue. Today, we're about a $200 million enterprise value business, and we're 75% owned by board, management, family offices, and then institutional gold investors like Merck, Ixios, and Franklin Templeton. So we've seen our register consolidate around really cost-efficient progress, really low dilution, and of course, strong board and management alignment. Last year, we were added into the All Ordinaries Index in September. So we're really starting to sort of form a corporate or capital profile that's quite appropriate to our transition towards commercialization. In terms of our capital structure, our human capital is very important. We've developed a team that has collectively a very great deal of experience finding, permitting, financing, building, and operating major mining assets. About half of our team are formerly of Normandy Mining, obviously a very well-known name in the gold space. It's also a very well-known name in South Australia. So all of our team, myself accepted, are native South Australians or sort of adopted South Australians. We've got very strong relationships in the community with government. We are setting about building a South Australian champion, which is something that is a little bit unique now that Oz Minerals has been absorbed into BHP Billiton. When we look at this on a map, the Three assets you can see in the top left of that map are the assets we originally acquired. Our Central Gawler Mill is at our Challenger asset in the very top left corner. What we did was focus on the middle of that map in the first place. Again, we wanted to create a pathway to scale. So we went to our Tunkillia asset. We grew that from about 0.6 to about 1.6 million ounces of gold. We did that very cost efficiently. The all-in cost of discovery there on a true all-in basis was less than 20 Australian dollars per ounce. So we have been very, very capital efficient. We then published a study demonstrating that that will be a very cost-efficient gold producer, and then went back up to Challenger, did 2 resource upgrades, and put out a study showing that we can refurbish and restart that mill quite cheaply. So that's brought us into the year here. Since November to now, we've done about 35,000 meters of drilling. We've got another 25,000 meters of drilling underway across Challenger and Tunkillia. And again, to look at Tunkillia, that will be advanced to measured and indicated and a pre-feasibility study to support our mining lease application. This is kind of our middle distance, medium term asset. And Challenger, we're looking at what are the near term startup configurations and options that we would look at. That is having resource upgrades, a definitive feasibility study as well. The Wudinna project at the bottom of the map is something that we bought that can be a very interesting supplemental asset to either our existing or planned future mill. I'll explain that a bit more. And the Tarcoola project, which we'll come back to, sits right between Challenger and Tunkillia. Now, this was the original high-grade gold field in South Australia. That's where we've made a surprise high-grade silver discovery right between the current and planned future asset. Existing mill, Central Gawler Mill, or what we call our Stage 1 asset. This is a 600,000 ton per annum facility. It was last operating in 2018. We published a study last year indicating that you could refurbish the mill itself for around 30 million Australian dollars. So we've now expanded this into a full-scale definitive feasibility study looking at the mill, options to potentially expand that, make it more efficient, look at the rest of the site, and then also upgrade all of the mineralization to indicated status that will feed the mill. And what we're looking to do here is to establish a low-risk, low-cost transition from pre-operations to operations, right? So we have an existing piece of infrastructure. The win is becoming a producer, right? We do not need to do anything crazy. We don't need to spend $400 million. The win is safely transitioning from pre-operations to operations and then unlocking the development optionality of everything else around us, including our historical high-grade underground. So this is something that we're working on. We'll be completing this DFS by the end of this year. The idea is, get that into operations, start generating cash, and then go and develop Tunkillia. Now, Tunkillia is the asset that takes us to scale, and this asset is the one we grew up to 1.6 million ounces. We published a study in May of last year that demonstrated this will be a very efficient producer. We modeled this as a 5 million ton per annum plant. And Tunkillia is really a study in the economies of scale, both in capital and operating costs. It's an asset that sort of behaves the way that you would expect to see for a bulk 5 million ton per annum operation. We optimized the pits to produce about 940,000 ounces of gold and about 2 million ounces of silver. We optimized the pits at 3,500 Australian dollar gold, and then we modeled the revenue at 5,000 Australian dollars. So if you think about that sort of pit constraint and those prices, $5,000 gold, $50 silver, this produces the type of revenue and operating profit and NPV that you would expect to see from an asset of this scale. But it has unusually high returns in terms of the internal rate of return and a very fast payback period. And that's because hiding in the middle of the main deposit here is a higher grade zone of mineralization. So in that main open pit area, we suspected that there was something hiding there. That was one of the first things we drilled. We validated this. Essentially, in a 3 kilometer long deposit, there is a 300 meter long zone right in the middle where if you take a cross section, which is what you can see on the right-hand side of the slide here, you're looking at the broadest mineralization in the whole deposit. So this is 80 to 100 meters wide, so very big, very bulk efficient. You're gonna have large equipment, low unit costs, and high profitability. But inside this, you actually have 10 to 30 meters of mineralization that grades between 2 and 10 grams per ton. The effect of this is you're naturally going to want to start your mining there. And when we flip that cross-section back into a long section and see what that looks like, we get to these sort of staged development model or pit stages here. Now, you can compare the life of mine metrics of this operation. So 5 million ton per annum, 0.8 gram, 120,000 ounces per annum, and you get about a 2,200 Australian dollar cash cost, about 2,220 all-in sustaining cost. If you look at that starter pit, what you get in that starter pit is a slightly higher grade, where instead of getting 120,000 ounces per annum, you get 180,000 ounces, and then you get 150,000 the next year. The effect is we actually bring forward and accelerate a huge amount of economics. At the current gold price, when you push $400 million into building this asset and doing the pre-strip, you get $2 billion back in profit in the first 2 years. So the payback profile to this asset is extraordinary, and that allows us to pay back the development capital, start returning capital to shareholders, and invest in growth. 3 things you don't normally get to do at the same time in mining. We also then think about what are other sources of high-grade mineralization that we could blend into that plant to continue those very high return metrics. This is where we look at the Wudinna asset. This is the asset that was on the south of our map. Wudinna's got 3 interesting characteristics. One, well, it's got 280,000 ounces, but it's near a highway. And this is a highway that runs and connects to our existing mill and our planned future mill. It also has back roads that go up to the side of our Tunkillia project. Second interesting characteristic is that it has very interesting metallurgical features. So it has very high gold recoveries to traditional gravity and leaching. But the test work indicates that we can actually very efficiently produce a high-grade concentrate here. So instead of building an entirely new third mill and spending $300 million doing that, we can just produce a crush, grind, and flotation circuit and concentrate 90% of the gold into 6% of the mass, which means instead of a comparable 600,000 ton per annum plant like Challenger, which is producing gold bars, we crush, grind, and concentrate 600,000 tons into 36,000 tons of high-grade concentrate, and that's just 100 tons per day of high-grade concentrate going in 1 or 2 trucks up the highway and into our mill and supercharging those economics exactly like we see during the first year of Tunkillia, when our cash cost of production is less than 1,000 Australian dollars per ounce. So the lesson in Tunkillia is that you get efficiencies of scale, you think of like horsepower, but you get marginal efficiencies or economic torque to marginal grade. That's what we're targeting with a Wudinna asset. Third interesting characteristic here is some of these deposits are actually on freehold land. So this is something that we can look at accelerating to blend into our Tunkillia development project in the medium term. That takes us to Tarcoola. Again, I told you this was between our existing mill and our planned future mill. This was the original high-grade gold field of South Australia, and then we found a silver discovery. So we did work to predict new gold structures. We made a new gold discovery, and then we realized it's actually a silver discovery with high-grade gold in it. We drilled Tolmer first as a gold discovery, and then we realized that there was an unusually high silver ratio. Typically in the Tarcoola gold field, for every 5 parts of gold, you'll have 1 part silver. And you can see this fairly consistently through its history of production. The first target we drilled here, we realized there were 30 parts silver for every 5 part gold. And then we drilled 500 meters to the west on the left-hand side of that screen. And our first drill hole in what we call the Western Silver Zone was 6 meters at 4,750 gram per ton silver, plus 13 grams gold, less than 50 meters from surface. So we've now drilled that a couple of ways. There's some very interesting things coming out of this. It looks like we've got a lower grade shallow horizon from surface, about 100 gram material. And then you've got that lower horizon there, about 50 meters deep, where you have silver between 100 and 17,600 gram per ton silver. We've done some test work recently, some very basic pan concentration of these materials, and came up with a very high grade test concentrate that's now going off for metallurgical analysis, but that was a 100,000 gram per ton silver concentrate. And we've now expedited drilling to drill this on a different orientation. We're going to drill through this again and see if we can test some of the extensions that are indicated in soil assays, I should say soil samples, that we've taken around a number of holes that grade over 2,000 gram meters of silver. So Tolmer is a very interesting exploration prospect for us, adjacent to our dual hub and spoke gold development model. And really for us, 2026 is about commercializing gold and figuring out if we can maybe commercialize some silver as well. We have got an incredible amount of work going on. We've created a very unique platform where we have most of the gold. We have all of the infrastructure. We will have more of all of the infrastructure when we build our second plant. And really, we think Barton Gold is a story for everyone, whether your preferences are relative valuation, discovery, near-term catalysts, near-term production, long-term scale. We have something for everyone. We'll be putting about 30 to 40,000 meters of assays out, multiple resource upgrades, multiple feasibility studies, and a pathway to operations during this year. So please check us out. Thank you very much.